So that's how it's done with the snowball method when you're already in debt. We've shown that that's a good time to borrow money from your cash values. The other one, again, back to the other way of spending where we save our money first, then we buy something, go back to zero, save our money, go back. But again, now we're going to add in the component of the guaranteed compound interest and the positive spread, and let's see how that works. What I don't understand is why the gurus of get out of debt will say whole life is a bad investment, buy inexpensive term insurance and invest the difference. As we've just shown, warehousing your money and being able to get a benefit of between 4 and 6% is not investing. This is a warehouse. Investing is where there is risk and reward, ups and downs, and hopefully a return on investment that is greater than what you can get here. Okay, back to Julia. We're going to show how she can use this again to save a little money and still use the positive spread, or as we call it, using your money twice. I'm going to use this one here, this column here, the non-guaranteed column, and I'm going to assume that in year 5, she now has $55,931, and she wants to go out and buy a car, right? When she asks the insurance company to borrow $50,000, there is no credit check. There is no application. She just sends in an email and says, I want $50,000 in this case, right? And the insurance company doesn't care if she uses it to buy a Volvo or whether or not she uses it to go on vacation. Probably a Volvo would be better these days instead of going on vacation around the world. Here's the question. Where does she borrow that money from? And a lot of people think that it's coming from their cash value. It is not. This is a loan from the general fund of the insurance company. You know, back in high school where your teacher used to stamp their foot on the floor and say, pay attention to this. This is going to be on the test. This part's going to be on the test, folks. Julia is not borrowing money from the $55,000 in her cash value. She is borrowing money from the general fund of the insurance company. Yes, her cash value and her death benefit are, if you will, acting as collateral. Therefore, it's a zero risk game for the insurance company, because if she passes on tomorrow, they were going to give her the death benefit anyhow. They'll subtract out the amount of her loan from the death benefit and her heirs will get the difference. With me? But she is not borrowing money from her cash value. That is not going down. That is going to remain the same. So her $55,931 will still continue to get 4% compound interest, that positive spread we were talking about. So let's look at the numbers and see how that actually works. What I did is I went to amortization.calc and I looked up a $50,000 note over 5 years, because that's normal for auto loans, at 5%. And that comes up with a payment of $943. Now that's the $943 that she would have to pay every single month if this were a structured loan. In other words, on the 5th of each month, she owes her auto payment of $943. We're going to run these numbers as though Julia is paying herself back through a structured loan. But keep in mind, with an insurance company, there is no structured payback. She can pay back if she wants. If she doesn't have to. In other words, let's say that because of the coronavirus, she gets laid off, right? It doesn't matter. She doesn't have to make a payment that month because she got laid off. But again, this is an infinite banking concept, and so what we want to be is an honest banker with ourselves. In other words, she wants to pay herself back that 5% that she would have been paying to a bank, and that's why I've created this as though it was a structured payment process, okay? So as we just saw a minute ago, that first payment of $943, $735 is going to go toward principal in the first month, $205 is going to go toward interest. Because this is simple interest, not compound interest that she's paying back. Now she's only paying interest on the second month on $48,526. Therefore, the interest that she's paying drops to $205 and the principal goes up to $738. Okay? So if we draw this out over a 5-year period, Julia will pay $6,614 in interest. The first year, she pays $2,295 in interest, and her balance goes down from $50,000 to $40,972. Year 2, again, she pays $1,833 in interest, total principal of $9,490. the balance drops to 31. Now she's only paying interest to the insurance company on the 31,000. In the next year, she pays only 1,348 in interest and drops her balance to 21. You get the picture. That's how she ends up paying 6,614 in interest back to the insurance company. But the real question isn't that. Okay, we can see how we easily get the amount of interest that she pays. But the real question is, what happened to the 55,000 that Julia had in her cash value? Or to be fair, the 50,000 that she borrowed back. What happened to that during 5 years? Remember, her cash value is still getting 4% guaranteed. So if we take $50,000 over 5 years at an interest rate of 4%, Julia has just made $10,832 on her cash value, moving it up to $60,000. Okay, so if we subtract from the $10,832 that she made in interest on her cash value, and we subtract out the $6,614 that she paid back to the insurance company in interest, she still netted a positive spread of $4,206. That is what makes borrowing from your life insurance policy so powerful. The positive spread. The amount the insurance company paid her, $10,800. The amount she paid them, $6,600. Positive cash flow, $4,206. That is what makes this principle so powerful. That is what your family banking system is all about, putting your money to work twice. The more money that we can put through our warehouse gives us a larger amount that we can borrow from. And as I just explained a minute ago, we want to pay ourselves back honestly. We don't have to. It's an unstructured loan. But if we pay ourselves back, like in the example of Julia there, where I had her paying back that auto loan at 5%, we pay ourselves back. Now we're the ones making that 5% interest, not a banker. And all of that is going to help us now toward retirement. So